What's up, investors? Ken here from the Dyslexic Investor, and we're looking at some saving tips that I've learned the hard way on trading options and being in the market for about 18 months doing options trading. Just want to do a quick recap. Here's the S&P 500 looking at a daily chart again on this little D here on a yearly time frame. So looking at here, we hit a wonderful high here in the beginning of May, and they have this saying, it's like sell in May, go away, or I'll post it up here. And it literally went down majority of the month on this downtrend, not cutting too much above this yellow. Again, the yellow line is the 21 exponential moving average over 21 periods of closing of the stock. So this is basically the reversion to the mean of what we hear that word a lot in trading, where it requires something to reverse. It doesn't go at least 1 to 2 standard deviations from this line very often, and if it does, you just buy or sell it depending on that. That's very basic rundown. So you can kind of see it didn't really close that much in basically the whole month of May, but then the beginning of this month, we got this terrible news with China stuff and economy slowing and all this other stuff with Mexico tariffs and everything. But majority of that stuff was just changed with just the president making a deal with Mexico just a couple of minutes ago, about 30-40 minutes ago, and the Fed saying that they're going to most likely cut rates that they did back in December, all that good jazz, and the market just loved it. And then this past week we were down Monday substantially, bought some QQ calls and SPY calls that expired 2 weeks from now and so forth, and just rode them up, selling them around 10:45 Eastern Standard Time today, and just a beautiful up ride here. With all this good news, this definitely could carry on into Monday. I just didn't want to risk it because this was a pretty fascinating move that I caught here. But then, so what kind of options did I buy with this move? So I do a lot of my charting within Thinkorswim, which is here. Do a little bit of trading on Thinkorswim, but I do most of my option execution on this wonderful platform called Tastyworks. It's great for options. It's very cheap. If you're interested, I'll put a comment or a description down below too on how to get involved and get it downloaded. All right, so this is basically, I have no positions, but I cleared everything out. So they have this wonderful thing, and this is the SPY, the stock we just recently looked at. So this is the 21 days or 14 days out options that I was trading. Would have been longer out because I bought them on Monday. So this is a quick little breakdown of how this system works. You can kind of see here, this is the in the money calls, this is in the money puts, and vice versa, out of the money, out of the money. And then this first blue line is standard deviation 1, 2, I don't think they do a 3. No, they just do 1 and 2. That's the more common ones. So what I did first learning trading options was I was buying these low, like, ooh, I can buy this for 30 cents. I can buy this guy for 30 cents. This is fantastic. I can buy this for 30 cents. But the probability of profit on that trade at expiration is only 7 down here, and that's substantially low. I'm risking 30 cents, 30 bucks, and the decay on that, it's only 14 days out. That's going to slowly, it's a done deal. So what I did when I bought my calls, I bought them pretty deep in the money, and then you can kind of see here, this is the open interest and volume up here. So SPY is going to get a lot of activity, but it's like the #1 traded thing for options. So you're going to see a heavy volume. And I bought like deep in the money. It was like $3 or $4 deep in the money, and that helped me get a good bounce from things. But also, yes, if I would have bought these probably for 30 cents out here, I would have got a better return in this. These guys are, delta is like what, 20? Let's see what their delta is. 10. So if the stock moves $1, this is only moving 10 cents. So, and it moved $5, so this would have gone up just a hair, but it probably would have moved faster due to the fast of the volatility and everything. It just moved so rapidly. These things would have popped and made you quite a bit of money. I think the deal spot would have been like the 40 delta, so in the middle. But again, that's the sweet spot in the sense. But to be consistent and consistently making money in this business is you want your probability of profit to be higher. So these 284s are basically double the probability of profit in the money to make you at the end of expiration. Yes, you're paying a substantially higher price, but with that price, you're going to get a better benefit of having time on your hand, having it in the money, and so forth. And yes, you're paying a lot more, which a lot of people look at. So, if it's paying $6, just turn it into a spread to sell one like $2 or $3 below it, and then it basically cuts it in a third. Yes, you're limited in your upside, but again, you're not trying to hit a home run every single time. You're just trying to make that's wrong. Make a little bit of money here and there. So you only can make $80 on it, but your max loss is pretty high. So you sell usually go like something like this. So 57%, really high. I'm risking quite a bit to make 150. Usually I have a stop or I cut my losses fairly fast. So if it goes red that day, I'm just out of it. I just don't even give it a chance to try to recover anything from there. So that's like one way of just doing bigger spreads, or just buying the straight out call. Like SPY and some other ones are pretty easier to buy just the call straight out. Apple, like of course Amazon, which is just a beast of a stock. These calls are $50, $52 in the money. You're gonna have to definitely do spreads on those, and those can pay off substantially if you get a nice bid into those. I didn't have the guts or the conviction to jump into Amazon because I'm afraid the president could start talking about them again, because their little feud between Mr. Bezos and President Trump. Never know when that can come back. So that's like one thing that I've learned is just to buy the in the money calls. I honestly like to trade them first, so I would have bought like the 42 days out. I consider that as somewhat of a short-term trade, and just getting some of that premium build up there. Another thing would be the opposite. It's just you hear this word selling a naked put or a naked call, and a lot of people are like, "Oh, you never do that." Like it's stock. Example, if I sold the Amazon 1740 put, okay, my max profit is only 3,500, or my max loss is basically infinite. Like I don't have, it can only go to zero, but the stock can literally go to the moon. So that being said, I'm this a little analysis. Let me show you this guy. So this is basically what I'm saying is I make money if it stays below that 1740, but what the heck? Clear this. Go here, table. I sell this guy, and then I go to nope. Active. There we go. So basically, if it breaks the break-even point if I have to sell this, it has to stay above of that put, and I will collect that premium there. It's a 74% chance of that happening, which is more likely than a 20% chance, right? But Amazon does fluctuate quite a bit, and if this poor guy just came crashing down, you could lose a substantial amount of money, because when you sell a put, you're just basically saying, I want it to go higher from here. It's going to be above, or it's going to be basically above where I bought it. And so the strategy for a lot of these would be just selling something that was like near the standard deviation of like a little bit out of the one standard deviation, and selling it like 40 days out. I've done that, but what I've done is just made that into a spread. So I would sell the guy and then like buy this guy here, probably a bit more like this. Yeah, you're not making, the probability is fantastic. If just letting it sit there, maintaining it, you might need to roll it to get out of things, but it's very important to understand that don't be fearful of these, because my options tradings, I started watching YouTube videos, and then everyone's like, oh, please don't sell a naked put or a naked call. Like it's basically shooting yourself in the foot. But if you understand, you know what you're doing, you're watching the market and so forth, and you normally, I don't like to do it in stocks or in equities. I usually do it in the SPYs or the Qs, aka the noodles, as my mentor has called them, the noodles. Yeah, so I wouldn't sell a put or a call straight in the money, because you can see here you're infinite, because if you sell a call, you're basically saying it has to go to zero. It's got to go down from this point. But the thing is, the stock can go from zero to the moon, aka to the sky, unlimited, aka infinity. So your capital loss can add up pretty fast. And the reason I usually don't short or I do spreads 99% of the time. I've never done maybe once or twice a naked call or naked put. The understanding of that is just to be sure that you know what you're doing, because here, like, let's say I bought, I was like, man, this market's going down. Like, I'm gonna sell a naked 240 naked call here. In hindsight, that's terrible, of course, right? But everyone was beating everything down. It was Christmas. It was the worst Christmas ever. It was Christmas Eve, and the market was going down. There's no end in sight. And usually people will be like, okay, I'm piling in short now, because that's the momentum, right? Everyone's going down, blah, 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 blah. So if you would have bought that, and this would just rode, and of course, but you would have got a margin call within like a week, because you can get to see these huge eruptions of green candles and just continually climbing and so forth. Like it would have been a nightmare to be able to do that. Another tip that I do is, usually if I see things like this, I'm looking to buy. I'm not looking to sell, because I don't want to be with the trend. I want to kind of be within a day or two of the switch. Like here, I was within a day of the switch. I was within like 2 or 3 days of the switch, 2 or 3 days of the switch down here and here, and just looking at different oscillators. I love the RSI. RSI is fantastic on understanding oversold and overbought. Again, things can be oversold for a really long time. Majority of the indexes will not stay too long oversold or overbought at any given time, but it does happen. You can kind of see here for about a week it was overbought. Right then and there, right before we had that downturn in May. Yeah, so I can chit chat about options and trading forever. I'd like to thank everyone for watching. If you're interested on checking out Tastyworks, I put a link down to what they do and an account and so forth in the description below. I'd like to thank everyone for watching again. And if you have any questions, put them down in the comments. Gladly to answer them. Catch you guys on the flip side. Peace.